Hi, and welcome to my monthly Market Insights video. My name is Dan Timotich. I'm a managing principal and a portfolio manager at T2 Asset Management. Before we get started, just a reminder, this video is for educational purposes only. The opinions expressed in this video are mine, do not reflect the opinions of others. You should always consult with a financial advisor before making any investment decisions. Investments involve risk and are not guaranteed. Okay, just when we thought things couldn't get any more crazy in the world, we get to this week and start to reopen the economy, and we all of a sudden enter this new phase of riots across America. I just want to say that I'm deeply saddened by what I've been watching over the last week, and I just hope that our local governments can put an end to this, to these riots before more people get hurt and more businesses get destroyed. But so far, after about 2 months of complete shutdown, the markets seem to have just shrugged it off, and in May, we see that all the major markets had a pretty strong month. Led by the Nasdaq primarily, and small caps both were up nearly 7%, and even high yield bonds had a good month. They were up around 3.5%. All of this chart here just shows the sector performance in May, and it looks like all 11 sectors did well. They were led by consumer discretionary, technology, materials, and yes, even energy had a good month finally. All in all, it was a pretty good month across all sectors. Looking at things on a year-to-date basis, however, we can clearly see a different picture. The only standout this year is technology. Energy is still down nearly 35%. Financials are down over 20%, and industrials are down over 16%. These sectors are really signaling that we have a long road ahead of us in terms of economic recovery, and so we definitely want to be careful and pay attention to what's going on. So let's take a look at how my Corp equity portfolio, it's basically my all-stock portfolio, how it was positioned for the month of May. At the end of April, I held about 66% exposure to stocks and about 34% in cash. By the time we got to the end of May, I was increasing my cash position, and that went up to 42%, and my stock allocation went down to 58%. Now, you may think that the large cash position would have caused the portfolio to underperform the S&P by a wider margin, but in reality, with the S&P up about 4.5% for the month, I was able to capture about 90% of that return while holding over 40% in cash. My allocation to cloud computing, tech, and communications was a huge driver of performance for the month, so even the big cash position didn't have much of an impact on overall performance. In my mind, my goal is always to try and capture somewhere around 80 to 90% of the upside of the market while only being exposing the portfolio to about 50% of the downside. This doesn't mean that it's always going to work, and we're not always going to hit those specific goals, but so far this year, it appears to be the case. Again, if you want more information specifically on performance among our different models, please email me or call me, and I'll be more than happy to share it with you. My point here is that investors need to be very cautious at this point. The market has recovered nearly all of its losses for the year, and things have gotten worse, not better. This may be a very good time for each of you to reevaluate your allocation and make sure that you understand how you are positioned. So let's talk about why I'm concerned. First and foremost, the Atlanta Fed just released this estimate for second quarter GDP. Are you ready for it? They expect the economy to fall to nearly 53% in the second quarter on an annualized basis. Now think about that for a minute. We have never, ever seen a contraction like this. We are in a real and deep recession. Now I know the official definition of a recession is 2 consecutive quarters of economic contraction, but I don't care who you are, a 53% contraction in one quarter is a recession regardless of what the final first quarter number is going to be. Put it this way, during the financial crisis, we had GDP contractions of 0.2%, 1.9%, 1.1%. Today, we're talking about real economic destruction that will take a long time to repair. Now, I've been cautioning for months with regard to earnings that they will not be anywhere near as strong as forecasted, and the estimates continue to get ratcheted down. And just when we thought the economy was reopening, obviously the riots around the country have not only delayed the reopening, but they have added destruction across so many businesses that even if local governments were allowing business to operate, they still need to rebuild those businesses in order to operate. And finally, last month I expressed my concern about the permanent displacement of the middle class. Look, we have over 40 million people unemployed in this country. The number is way higher if you include the underemployed. What will happen when the supplemental $600 in unemployment expires at the end of July? I'm not sure, but in a survey, 90% of those unemployed think that this will be temporary and they're all going to return to work. I unfortunately don't think so. Combine the economic destruction from the shutdown along with the destruction caused by the riots, and you can easily see that many businesses will simply close their doors forever and never reopen. Now, I wanted to revisit my earnings slide from last month. Here we can see that consensus EPS last month for 2020 was $149.95, and my internal model forecast was $134.98. I also said last month that I expected my number to be lower as we get more data coming in. Well, we certainly did get more data, and now consensus EPS is down to $128.03, and my forecast is $124.02. As you can see here, whether you use my numbers or consensus numbers, the market needs to fall significantly to just get back to fair value. I'll let you decide if you think a 15, 16, 17, or 20 PE is a fair multiple for earnings. But remember, when you invest in stocks, you are investing in the future earnings of those companies. Right now, you're picking up pennies in front of a bulldozer, and everybody needs to be very, very careful. So with the S&P 500 at 3,065 at the time of this video, and we use consensus earnings of 128.03, we get a PE ratio of 24 times. Using my earnings estimates of 124.02, and you get a multiple of 25 times. Any way you slice it, if you're asking if the market is overvalued, the answer is simply yes. So what's driving the market action? How can the market just keep going up? Well, I think there's two primary reasons for it. The Fed has ballooned its balance sheet to levels that nobody's ever thought possible. It went from $3.9 trillion a year ago to over $7 trillion today. That's an 82% increase in a matter of a year. This doesn't even take into account the daily repo that it continues to support. And the second factor is the money supply. M2 measures money supply, which includes cash, checking deposits, savings deposits, money market securities, time deposits, etc. It basically measures the amount of money available for immediate use. M2 has grown from less than 15 trillion a year ago to over 18 trillion. That's an increase of 23%. For perspective, at the heart of the financial crisis, M2 only grew at about 8%. Now, this doesn't mean that the market will crash, but it does demonstrate that the run-up in the market is a function of leverage and not fundamentals. The reason that matters is that at some point, the leverage will be removed, and what follows is never good. This may last for months or years, but eventually it will end. I dug up an old chart from 2018 and wanted to remind you of what happened in the fourth quarter of that year in 2018 when the Fed simply signaled that it was going to raise rates and take liquidity out of the market. The market fell nearly 22% in 2.5 months. Another chart I dug up is from my video back in February of this year. As a reminder, the Fed has pumped the repo markets in the past, so let's take a look at what happened in previous situation. This chart here is from Bianco Research. Back in October 1999, the Fed pumped billions of dollars into the market over the Y2K concerns. And while the Nasdaq was already up about 40% by that time, the Fed fueled an additional 46% gain in the fourth quarter of 99. When nothing happened after the clock turned on January 1st, the Fed realized it needed to take back some of that liquidity. It did so on April 7th, and the Nasdaq simply crashed 25% in 1 week and finished the year down about 40%. I remember those days clearly. It was so obvious that the Fed was responsible for creating the Nasdaq bubble, and when they took away the punch bowl, the market responded. So what can possibly go wrong when the Fed decides to take away the punch bowl this time? Remember, the amount of money that the Fed has pumped into the system this time around makes 1999 look like a walk in the park. Now, look, I know this month's outlook is not all rainbows and unicorns, but it's my job to manage risk. The market has rewarded those that went through the pain of March, but it doesn't mean that we're out of the woods right now. The recession is much worse than people think. This is certainly worse than the 2001 recession, and it's worse than the financial crisis of 2008. The recovery will not be a quick V. The economy will not reopen fully as soon as people think. The riots have basically extended the economic shutdown by several weeks, and this is going to take time for people to repair and get back opened up. The recent run-up in the market, as I said, was driven primarily by leverage and by program trading. I think investors should be patient here, reevaluate their holdings, make sure that you know where your risk lies, and remember, you don't have to be 100% invested in the market at all times to do well, as I discussed a little bit earlier in the video. And finally, don't chase returns. This is no place to be a hero. I have my wish list of what I want to own with the 40% cash I have, but I'm not willing to buy more of it at these levels. Do I want to have more of what I own? Of course. It's just at these levels, it doesn't seem reasonable for me to be redeploying that cash. The market will get cheaper. It may not happen immediately, but you shouldn't be a day trader trying to figure things out on a day-to-day basis. You should be an investor looking at opportunities to invest when the market allows you to invest. Thank you all for watching. And if, like I said earlier, if you want any more information on any of these topics I covered, or if you want information on our investment strategies and performance, please give me a call or send me an email. I'll be more than happy to respond. I hope you all stay safe, and I'll be back again next month. Thanks again for watching.